The housing market crash isn't coming. It's already here, hiding in plain sight while most Americans sleepwalk into disaster. Forget the soft landing fairy tale. The numbers tell a darker story. Inventory piling up at the fastest pace since 2008, sellers slashing tens of thousands off their asking prices, families drowning in foreclosures, and buyers locked out by the worst affordability crisis in 40 years. This isn't speculation. It's blood on the streets of real estate. Today we're exposing 5 shocking signs that prove the housing market is already collapsing and why the worst may be yet to come. Number 1. Surging housing inventory. If you want to know whether the housing market is collapsing, you don't start with mortgage rates or Wall Street speculation. You start with inventory. Because housing inventory is like the pulse of the market. When supply surges faster than demand, it's not just a red flag, it's a fire alarm. And right now, the numbers are blaring. According to Realtor.com, active listings nationwide jumped nearly 29% year-over-year by April 2025. Sounds manageable until you realize that's the steepest increase since the 2008 collapse. But here's the kicker. In some states, the numbers are downright catastrophic. California's inventory? Up 36%. Colorado? Closer to 40% in certain counties. In Phoenix, Las Vegas, and Austin, the very cities that saw prices double during the pandemic boom, homes are now flooding the market at a pace nobody can absorb. Think about it. A house that once sold in 10 days is now sitting for 45 to 60 days, and that's not the exception. It's becoming the rule. In high-end segments, luxury homes are gathering dust for 90 days or more. Inventory isn't just rising, it's stacking up like unsold cars on a dealer's lot, waiting for desperate markdowns. And here's the shocking part most analysts won't tell you. This surge isn't being fueled by builders dumping new homes into the market. In fact, new construction permits have slowed. What's actually happening is far scarier. Existing homeowners are panic listing. They see the storm coming. They know affordability is dead. They're bailing out before their equity vanishes. This is the exact same domino effect we saw in 2006 and 2007, but with one key difference. It's happening in slow motion. Let's put this into perspective. Imagine a city with 10,000 active listings in 2023. Fast forward 1 year. Now it's 13,000 listings. That's 3,000 more homes competing for the same pool of buyers who are shrinking in number thanks to 7% mortgage rates. And the math gets uglier. If just 30% of those homes slash their prices by $50,000, that city's total housing market just lost $150 million in collective value. Multiply that across America's largest metros, and we're staring at a $1 trillion equity drain in progress. And the problem feeds itself. The longer homes sit, the more desperate sellers become. The more price cuts appear, the more buyers back away, thinking, why buy today if it'll be cheaper tomorrow? That psychology alone can kill a market faster than interest rates ever could. Some neighborhoods are already ghost towns of for sale signs. Drive through suburban Sacramento, Denver, or Tampa, and you'll see it. 3, 4, 5 homes for sale on the same block. This isn't just an uptick in supply, it's a liquidation event playing out in real time. And here's the scariest truth. Inventory spikes always lead the crash. In 2006, inventory started climbing in mid-2005. Home prices didn't truly collapse until a year later. What we're seeing now, 29% nationally, 30% to 40% in hot states, is the exact setup to a market implosion. Sellers are racing the clock, and buyers are watching from the sidelines. So the first shocking sign of this housing crash isn't a prediction. It's the inventory avalanche already happening. And the higher it climbs, the harder prices will fall. Number 2. Price cuts. If surging inventory is the alarm bell, then price cuts are the gunshots in the street. You can't ignore them. They tell you in brutal, undeniable numbers that sellers are losing control of the market. And right now, those numbers are more terrifying than at any point in nearly a decade. According to Realtor.com, by May 2025, 19.1% of all active listings in America had cut their asking price. That's not a small dip. That's nearly 1 in 5 homes across the country slashing their tag. And let's be clear, these aren't cute little $5,000 reductions. We're talking $30,000, $50,000, even $100,000 cuts in metros where homes once sparked bidding wars. Take Denver. Just a year ago, buyers were lining up to offer $50,000 over asking. Today, more than 30% of listings in the Denver metro have cut their prices, many by 10% or more. Austin? Same story. Pandemic boomtown turned bargain bin. Phoenix? Identical. These aren't fringe markets. These are major U.S. cities that added millions of residents in the past decade. And yet, homeowners there can't even get a nibble unless they're slashing tens of thousands off the top. What makes this more chilling is the trend line. This isn't a one-off blip. May 2025 marked the 6th straight month of rising price cuts. 6 straight months. That's a free fall in slow motion. Every month, more and more sellers are throwing in the towel. And if you know housing history, you know this is exactly how 2007 looked before the market caved in. But let's zoom in on the psychology, because that's where the crash really takes shape. A seller lists a home for $500,000. After 45 days of crickets, they cut it to $470,000. Still nothing. Another month later, it's $450,000. Now buyers are circling, but not with offers. They're waiting. Why? Because the moment the first price cut hits, the buyer's brain flips. If it dropped once, it'll drop again. Suddenly, the house becomes radioactive. That's how markets spiral. One cut becomes two cuts become three, and soon, the entire neighborhood is repriced downward. And here's the devastating truth. The deepest cuts are happening in the very regions that exploded during the pandemic. The South and the West, Florida, Texas, Arizona, Nevada, California. These were the epicenters of insane appreciation from 2020 to 2022. And now, they're leading the way down. A house in Phoenix that listed for $600,000 in 2022 is now sitting at $520,000 and still not moving. That's an $80,000 vaporization of equity per house. Multiply that by thousands of homes in one metro, and you're watching billions in wealth evaporate. Families who thought they had built life-changing equity are waking up to find themselves on the wrong side of the slope, trapped in homes that may soon be worth less than their mortgage balance. Here's what makes it even worse. The cuts aren't working. Despite slashing prices, homes are still sitting. Why? Because buyers are sidelined by 7% mortgage rates and affordability levels not seen since the 1980s. This means sellers are cutting, but buyers still can't bite. That's the nightmare scenario, falling prices with no floor in sight. So let's be brutally honest. Price cuts aren't just happening, they're accelerating. And once they start, they don't stop until the market bottoms out. If you think this is just a correction, think again. The bleeding has already begun, and it's only going to get worse. Number 3. Seller concessions. Not every housing crash starts with a bang. Sometimes, it begins with whispers, hidden discounts, quiet handshakes, and under-the-table deals. That's exactly what's happening right now with seller concessions, the most overlooked but deadliest signal of a market in freefall. In the first quarter of 2025, 44.4% of home sales across the U.S. included seller concessions, according to Redfin. Translation: nearly half of all sellers couldn't get their home sold at full price. Instead, they had to throw sweeteners on the table, covering closing costs, buying down mortgage rates, offering free upgrades, even leaving behind furniture and appliances. In some markets, it's beyond shocking. Seattle? 71% of sellers gave concessions. That's not a balanced market. That's a clearance sale. Concessions are basically financial band-aids. On paper, a house still sells for $400,000. But if the seller pays $15,000 toward closing, kicks in $10,000 for repairs, and buys down the buyer's mortgage rate, the real price is more like $375,000. It's a stealth price cut, and it's happening everywhere. Now, why should you care? Because concessions are the canary in the coal mine. They reveal the true balance of power between buyers and sellers. When almost half of sellers are paying buyers to take their home, the balance is broken. Sellers aren't in control anymore, buyers are. That dynamic shift is exactly what we saw in 2007, right before the bottom fell out. The scary part is how fast it spread. Just 2 years ago, sellers were dictating insane terms. No inspections, no appraisals. Bidding wars adding $100,000 above asking. Today, it's flipped. Buyers are walking in with demands. Cover my closing costs or I'm not signing. Sellers are nodding because they have no choice. Imagine this. A family lists their home for $500,000. A buyer offers full price, but asks for a $20,000 mortgage rate buydown. The seller agrees. On paper, it looks like a strong sale. In reality, that home just sold for $480,000. And when the neighbor down the street lists theirs, they're forced to match the real price, not the fantasy one. That's how entire neighborhoods reset downward, quietly, invisibly, one concession at a time. It gets darker. Concessions pile on top of price cuts. In places like Phoenix and Austin, we're seeing sellers cut their asking price by $50,000, then add concessions worth another $15,000 to $20,000. That's not a negotiation. That's a fire sale disguised as creative financing. And concessions don't show up in the glossy housing reports splashed across the news. They're buried in the fine print of closing documents, which means the public sees average home prices holding steady, while in reality, values are bleeding out behind the scenes. So let's call it what it is. Concessions are desperation. They are the last weapon sellers have before outright panic sets in. And when nearly half the market is already there, you don't need a crystal ball to see what's next. This isn't balance. It's the slow bleed of a crash in progress. Number 4. Foreclosures and delinquencies. Picture this: rows of houses with overgrown lawns, notice of trustee sale taped to the doors, and families packing their belongings into rented trucks under the cover of night. It's not a scene from 2008. It's America in 2025. And if you think foreclosures are yesterday's nightmare, you're not paying attention. In the first quarter of this year, foreclosure filings hit 93,953 properties, according to Adam data. That's up 6% from just the previous quarter and 4% from a year ago. On the surface, those numbers may not sound catastrophic, but history tells us otherwise. That's exactly how the 2008 crash began, with a slow creep upward. Quarter after quarter, the filings stack higher until suddenly the dam bursts. Even scarier? Foreclosure starts. The first step when a homeowner officially defaults reached 68,794 in Q1 2025, up 14% in just 3 months. Think about that. Nearly 70,000 families entered the foreclosure pipeline in a single quarter. It's not a ripple, it's a wave gathering speed. States like Delaware, Florida, and Illinois are already flashing red. In parts of Florida, foreclosure rates are now 1 in every 900 homes. That means entire neighborhoods are teetering on the edge of collapse. The same story is unfolding in Chicago suburbs, where foreclosure auctions are starting to flood local courts again. But the real danger isn't just the raw numbers. It's who's defaulting. According to the Mortgage Bankers Association, FHA and VA loans are seeing faster delinquency growth than conventional mortgages. That's the lifeblood of first-time buyers, veterans, and lower-income families. When those borrowers start going under, it's like termites in the foundation. It signals systemic weakness, not just isolated pain. Let's put faces to the numbers. A young couple buys a starter home in Phoenix at the pandemic peak for $450,000 with just 3% down. Their mortgage payment at 6.8% interest is nearly $3,000 a month. Fast forward. The home is worth $400,000. Their car loan just spiked, and one partner lost hours at work. Within 90 days, they're delinquent. Within 6 months, they're facing foreclosure. Multiply that story by tens of thousands, and you see why these filings are piling up. The domino effect is brutal. Every foreclosure adds inventory. Every distressed sale drags down comps in the neighborhood. Every underwater homeowner who sees the house next door auctioned off for $80,000 less than theirs suddenly loses hope. That psychology spreads like wildfire. And here's the gut punch. Banks and lenders are already bracing. We're seeing an uptick in cash for keys offers, where lenders literally pay delinquent homeowners to walk away before foreclosure. That's not a healthy market. It's triage. Back in 2007, most experts dismissed the early rise in delinquencies as contained. We all know how that turned out. Today, we're watching the same script unfold. Delinquencies inch up, foreclosures tick higher, and then, when job losses hit or rates stay high too long, the floodgates open. The ghosts of 2008 aren't gone. They're back, haunting every corner of today's market. And this time, we can see them coming. Number 5. The affordability crisis. Every crime story has a villain. In this housing crash, the villain isn't Wall Street or shady lenders. It's affordability itself. A silent killer, creeping into every American neighborhood, suffocating buyers, and leaving homes to rot unsold. Let's start with the weapon. Mortgage rates. According to Freddie Mac's survey, the 30-year fixed rate is hovering near 6.8% in 2025, and it's forecast to stay above 6% through 2026. For context, the difference between a 3% mortgage and a 7% mortgage is the difference between life and death for buyers. On a $400,000 loan, that's nearly $900 more per month. That's not a minor inconvenience. It's the equivalent of an extra car payment, private school tuition, or a second job. The National Association of Home Builders reports affordability has collapsed nearly 30% since late 2021, plunging us back to levels last seen in the late 1980s. Think about that. 40 years of wage growth, technology, and economic expansion erased in a flash. Buying a home today is as hard as it was when Ronald Reagan was in office, but affordability isn't just about rates, it's about the perfect storm created by them. Home prices skyrocketed during the pandemic, rising nearly 40% between 2020 and 2022. Now rates are double what they were. That combination has locked millions out of the market. Even as sellers slash $50,000 off their asking prices, buyers still can't qualify. They're strangled before they can even step into the ring. Here's the sinister twist. Over 80% of homeowners in America hold mortgages at least 1% lower than today's rates. Many are sitting pretty at 2% or 3%. That creates what economists call the lock-in effect. In plain English, it means they're trapped. Selling their current home would mean swapping a $1,500 mortgage payment for a $3,000 one on the next house. So they don't sell, they don't move, they freeze. What does that do to the market? It fractures it into two realities. On one side, you have starter homes and investor properties flooding the market, driving inventory higher. On the other, move-up homes and family houses remain artificially scarce because nobody dares trade up. That distortion creates chaos. Buyers looking at mid-tier homes see rising inventory and slashed prices, but in certain segments, competition still exists. It's a schizophrenic marketplace where nothing makes sense, and affordability keeps hammering demand. In metro areas like Los Angeles, San Francisco, and Miami, a median-priced home now requires an annual income of $180,000 to $220,000 just to qualify for a mortgage. Yet the median U.S. household income sits at $78,000. That's not a gap. That's a canyon. Millions of potential buyers are permanently priced out, creating an entire generation of renters who will never cross the homeownership threshold. This is how affordability kills. It strangles buyers, traps sellers, and drains confidence from the entire system. It doesn't crash markets with a loud explosion. It suffocates them slowly, until no one can breathe. The housing market isn't being threatened by some future monster. The killer is already in the house, and its name is affordability.